Assalamualaikum and hello to Puan Arfa and everyone. We are from Group 2 will present on topic 6 and we will cover topic 6.1 until 6.5. Firstly, I would like to introduce myself. My name is Nur Shafika Alia binti Abdul Latif. My matrix number 01D8019F1009. I will begin my presentation with introduction of audit evidence. In auditing standard, ISA 500 explains what constitutes audit evidence in audits of financial statements and looks at the auditor's responsibilities in obtaining appropriate audit evidence. Definition of audit evidence is auditing evidence refers to the information collected by an auditor to ascertain the accuracy and compliance of a company's financial statements. To support the company's claims made in the financial statements and their adherence to the accounting laws. Example of auditing evidence include bank accounts, management accounts, payrolls, bank statements, invoices, and receipts. Good auditing evidence should be sufficient, reliable, provided from an appropriate source, and relevant to the audit at hand. Next, I will explain about sufficient and appropriate audit evidence. The auditor must plan and perform audit procedures to obtain sufficiently appropriate audit evidence. Sufficiency is the measure of the quantity of audit evidence. The quantity of audit evidence needed is affected by the following. First, risk of misstatement. In general, the higher the risk is, the more audit evidence is required to respond to such risk. Second, materiality of the account. In case the materiality of an audit engagement is higher, the auditor also need to increase the quality and quantity of audit evidence they must gather. Third, quality of evidence. As the quality of the evidence increases, the need for additional corroborating evidence decreases. And lastly is size of population. Okay then, appropriateness is the measure of the quality of audit evidence, which is relevance and reliability. First, relevance. The relevance of audit evidence refers to its relationship to the assertions or the objective of the control being tested. Example, to verify the existence of an asset, inspection of assets may be considered relevant audit evidence. Second, reliability. The reliability of evidence depends on the nature and source of the evidence and the circumstances under which it is obtained. For example, in determining the fair value of a financial asset, if such asset is listed in the stock market, we can directly use the stock market information to determine its value. Okay, next is liability under common law. The causes of legal actions against auditors under common law are gross negligence, failure to exercise even a minimal level of care, or reckless disregard, but without intent to harm or damage anyone. Second, breach of contracts. Third, negligence, failure to exercise a reasonable level of care that causes damage to another. And lastly is fraud. It is intentional concealment or mispresentation of material facts that cause damages to those deceived, or we call it as fainter. Okay, lastly is a breach of contract. Auditors have a contractual relationship with their clients. A breach of contract occurs when an auditor fails to perform a contractual duty. Like example, violating client confidentiality, failing to provide the audit report on time, failing to discover a material error or employee fraud, and withdrawing from an audit engagement without justification. And the court remedies to this breach is by requiring specific performance of the contract agreement, granting an injunction to prohibit the auditor from doing certain acts such as disclosing confidential information, and lastly, by providing for recovery of amounts lost as a result of the breach. And in auditor defense, auditor may exercise due professional care in accordance with the contract, and then the client was contributory negligent. The client's losses were not caused by the breach. Okay, thank you. That is all from me, and Nurul Izzati will continue with a presentation.
Thank you to Nur Syafiqah Alia. Hello, Assalamualaikum. My name is Nurul Izzati binti Mak Rosli. My matric number 01D8019F1007. Okay, now I will continue this presentation about liability to clients and third-party negligence. For the first point is action for the tort of negligence can be brought against accountant by the client or by a non-client third party. To be liable for negligence, there are 5 conditions to be fulfilled. First, the auditor owes a duty of care to the plaintiff to conform to a required standard of care. Second, breach of duty of care to the plaintiff on the part of the auditor. Third, causal relationship or connection between auditor's negligence and plaintiff damage. Fourth, plaintiff suffers actual loss or damage. And the last, it is fair, just and reasonable for the court to impose liability for the auditor. Second point is duty of care. The obligation to exercise a level of care as is reasonable in all circumstances in carrying out professional work. In the case of an audit, this will require auditors to exercise the level of skill, care and competence expected of a suitably qualified professional in circumstances. Okay, there are 4 duty of care in the auditor position. First, applying the most up-to-date accounting and auditing standards. Second, adhering to all standards of ethical behavior laid down by the relevant professional bodies. Third, being aware of the terms and conditions of the appointment as set out in the engagement letter and as implied by law. Last is employing competent staff who are adequately trained and supervised in carrying out their duties. Third point, only a negligent act will be regarded as a breach of duty of care. Fourth, based on negligence cases, it depends heavily on whether a duty of care is owed at all, because if auditor did not owe a duty of care, they cannot breach it, and so they cannot be held liable for the damage caused by negligence. 5. To prevail in a negligence suit, a plaintiff must generally prove that they are suffer a loss. Second, the loss was due to reliance on misleading financial statements. Third, the auditor knew or should have known that the financial statements were misleading. For the point 6, liabilities related to negligence. For example of situation in which auditor may be held as negligent. First, accepting a certificate despite suspicious circumstances. Second, failure to check detail in a certificate if there are adequate records to do so. And third, relying on unsupported and undocumented representation by management. Okay, next, example of situation in which auditor may not be held as negligence. First, accepting the certificate of a responsible official where there are no suspicious circumstances. Second, conforming to accepted audit practice. And the third is accounting standard have been complied with. Now we move to the 7. The courts have ruled that auditors can be held liable by clients and third parties who are reasonably expected to rely on audited statement. 8. Generally, courts have classified third-party user into 3 groups. First, identified user, which is specific individual user whom the auditor knows will be use the statement to make a specific decision. Second, foreseen user, while not individually known, belong to a specific group of user whom the auditors knows will use the statement. And the third one is foreseeable user, belong to a general class of user whose member may or not use the financial statement. And the last one, for the 9, a review of the key cases in this area will be able to provide some guidance on how the legal arguments have progressed and of the present position. Thank you. That's all from me. For the next slide, Siti Sarah will be continued. Thank you.
Thank you Nurul Izzati for your good presentation. Assalamualaikum to Madam and my classmate. My name is Siti Sarah binti Rushdie. My metric number is 01D8019F1010. Now I will continue with the last point that in causes of legal action against auditors under the common law. Okay, the last point in the causes is the fraud. According to ISA 2040, fraud refers to an intentional act by one or more individual among management, those charged with governance, employees, or third parties, and fraud involving the use of deception to obtain an unjust or illegal advantages. In simple words, fraud is the satu tindakan yang dilakukan oleh seorang atau lebih orang dalam sesuatu management tu. Dan fraud ni dia melibatkan sesuatu perkara yang illegal, dan faedah yang diterima melalui fraud pun adalah faedah yang tidak baik. So untuk fraud, we have 2 type of fraud. First is fraudulent in financial reporting. Second is misappropriation of asset. First, I will explain about fraudulent in financial reporting. There is involved three points. That is intentional misstatement, misrepresentation in or intentional omission from. Third is the intentional misapplication. For the intentional misstatement, there is manipulation, falsification, or alteration of accounting records or supporting document from which the financial statements are prepared. For the second is the misrepresentation in or intentional omission from. For this misrepresentation in is the financial statement of event, transaction, or other significant information in financial statement to deceive financial statement user. Third is the intentional misapplication. There is accounting principle relating to measurement, recognition, classification, presentation, or disclosure. Now I will continue with the second type of fraud. As you can see in the slide, that is the misappropriation of asset. So, misappropriation of asset are involved the thief of an entity asset. For example, embezzling receipt or debiting them into the private bank account. Second is stealing physical or intangible asset like inventorying or selling data. The third is causing an entity to pay for goods and services not received. That is the payment to various vendors. And the last is the using asset for personal use. Next is the cases that can relate with liability under common law. Okay, in slide that show the liability to third party under common law. Okay, for the ultramarines doctrine, uphold the privity of contract doctrine, the third party cannot sue auditors for ordinary negligence. Okay, the doctrine of privity in the common law of contract provide that a contract cannot confer right or impose obligation arising under it on any person or agent except the parties to it. Second, ordinary negligence is insufficient for liability to third parties unless the third party is a primary beneficiary or recipient. And lastly is the only parties to contract should be able to sue to enforce their rights or claim damage as such. However, the doctrine has proven problematic due to its implication upon contract made for the benefit of third parties who are unable to enforce the obligation of the contracting parties. So as you can see in this slide, there is cases that Ultramarines Corporation vs Touch ETL 1931. Okay. In these cases, the creditor of an insolvent corporation, Ultramarines, rely on the audited financial and subsequently sue the accounting for alleged negligence and fraudulent misrepresentation. As you can see before this slide, misrepresentation is the financial statement of event, transaction, or other significant information in financial statement to deceive financial statement user. So in this case, it involves the fraudulent misrepresentation. The account receivable of $650,000 was added with another fraudulent item of $700,000. The accounts payable contain similar discrepancies. The court held that the accountant had been negligent, but ruled that the accountant will not be liable to third party for heinous blunders beyond the bound of the original contract unless they are primary beneficiaries. The court held that only one who enters into a contract with an accountant for service can sue if those services are rendered negligently. The auditor were not liable to the creditor because the creditor are not deemed to be primary beneficiaries. Last, for liability under common law, as you can see in the slide, Auditor defense against third-party summon. Okay, defense against third-party suit, the 3 point, that is non-negligent performance, second is lack of duty, and third is the absence for casual connection. Okay. Before this, we saw the cases, right? So if you want to know more about the cases that involve liability under common law, you can refer page 276, 277, 278, and 279. On all these pages have the cases that related to liability under common law. You can read by yourself to get more knowledge or to get more understanding about this topic. Now I will continue with the next liability of auditors. There is liability under statutory law. Okay, you can refer in the slide. The liability under statutory law is the auditors are responsible to both the regulatory bodies and the client. The auditor may be liable to the client when there is a breach of contract. In addition, the auditor may also be liable for failure to comply with any relevant legislation. Liability under statutory law, also the written law enacted by the legislative arm of the government that establish a certain course of conduct that must be adhered to by covered parties. Example, under the Companies Act 1965, the auditors are liable to express their opinion on the financial statement of the client. The third is auditor have reporting duties under various other statutes such as BAFIA, SCA, and AMLA. This duty require the auditor to report to the relevant authorities violation of law or regulation they encounter in the course of performing their duties. Okay. In other words, besides liability under common law, auditor also can be sued by clients, shareholder, banker, investor, creditor, and the government for failure to perform adequate professional service pertaining to those state under statutory law. That is from me. Now I will pass the presentation to Nur Ain.
Hello, my name is Nur Ain binti Razali and my matric number is 0119F1001. I will continue the presentation about liability under statutory law, statutory liability to third party, criminal liability to third party, limitation of liability, partnership and agreements. Liability under statutory law. Auditors are responsible to both the regulatory bodies and the clients. The auditor may be liable to the client where there is a breach of contract. In addition, the auditor may also be liable for failure to comply with any relevant legislation. Written law enacted by the legislation arms of the government that establish certain course of conduct that must be adhered to by covered parties. Next, auditor have reporting duties under various other statutes such as under BAFIA, SCA and AMLA. This duty require the auditor to report to the relevant authorities violation of law or regulation costs of performing their duties. Statutory liability to third party. Under contract law, parties can seek remedy for a breach of contract obligation. Therefore, shareholder can seek remedy for an auditor if they fail to comply with the terms of an enactment letter. In Malaysia, legal action may be brought against auditor merely for violating the Companies Act 2016. In Section 167 of Company Act 2016, it provides for civil liability for misstatement in prospectus as aspect who authorize and cause the issue prospectus are liable to lay compensation to person who purchase share or debenture on the face of the prospectus for any loss by reason of untrue statement or willful non-disclose of any matter which is material. However, it can be not liable if they can prove that they have withdrawn their concerns before the prospectus was lodged with the Securities Commission Malaysia. Second, the prospectus was issued without their knowledge or concerns, or they have been given public notice after they become aware of the issue. Thirdly, they have withdrawn their concerns before the allotment or sale of share after becoming aware of the untrue statement and have given public notice of the withdrawal. Lastly, they were competent in making the statement and have reasonable grounds to believe that the statement is true. Criminal liability to third party. Auditor can be criminal proceeding under the corporate or securities law. The example of criminal liability are failure to report non-compliance under Section 266(13) of the Company Act 2016 and insider trading. If the auditor are found guilty, it will result in the auditors being given large fines and imprisonment. For the example case, you can see in the slide about WorldCom and Arthur Anderson LLP. Limitation of liability. The method that can be used are periodic protection of audit enactment partner, prohibit certain non-audit service for public company for audit clients, restrict other non-audit service for audit client, firm policies including training program that emphasize auditor independence and requiring each auditor to sign statement of independence, perform quality review of registered public accounting firms, and lastly, internal reviews, concerning partner reviews and inter-office reviews. There are also other actions that firm can take to ensure quality and minimize liability exposed, including issue and agree on the duties and responsibility in an enactment letter, making appropriate client acceptance or continuous decision, evaluation the auditor firm's limitation, and maintaining high quality audit documentation. Limited liability partnership. In general, auditors are prohibited by many jurisdictions from entering into arrangement with their client that will reduce or include their liability in relation to statutory audit work. However, this does not prevent a company from insuring an auditor against such liability. The agreement for such arrangement are: A. As company become large and their activity become global and as society become more litigious, auditors have to face increasing number of claims, including many that, if successful, will be beyond the financial means of the auditors. B. The concept of joint and several liability, where the auditors often face 100% of a claim because other defendants do not have the financial resources, is considered unfair. A leading firm may exit from the market for provision of audit service by being sued out of the market by a decision that the benefits do not exceed the risk. D. Firms and networks may not be willing to accept appointment as auditor to higher risk, entities. E. Auditor fees may substantially increase to cover higher risk. Competition between audit firms will not reduce the fees because the risk will be the same for all the firms. Limited liability agreement. Since 2008, auditors have been permitted, under the terms of the Company Act, to use liability limitation agreements to reduce the threat of litigation from clients. LLAS clauses built into the terms of an enactment impose a cap on the amount of compensation that can be sought from the auditors. This must be approved by shareholders annually and upheld by judge. A. Be fair and reasonable in circumstance. B. Be for the current year only. And lastly, C. Be approved by a resolution of the entity shareholders. And that's all for me. Thank you for listening.